You hear a 10% rally to the end of the year, possibly. Does that sound feasible?
I think it's feasible. It wouldn't be my base case assumption, but this is a seasonally strong time of year. I think the pullback that we saw over the summer has set us up now for a rally. I think a lot of people have gotten very defensive, and in my mind, it's time to put risk back into portfolios.
Okay, why is that? I mean, the Fed might be raising rates sometime soon.
They might be raising rates, but I think we've been told for 2 years now that it's coming, so anyone who's not prepared for it, I don't know what they've been paying attention to. Right. I think it's coming, and whether it's December, whether it's early next year, I think the market can cope with a modest increase in interest rates.
Okay, so what's got you bullish then?
I think just how negative sentiment has become. We saw the VIX number a moment ago. The VIX had been in the mid-20s for a sustained period. That's
right.
Unusual. If you look at cash levels, Merrill Lynch does a fund manager survey, and cash levels are at very high levels. The American Association of Individual Investors surveys retail investors. They're very bearish. All of these contrarian indicators say to me that the market's set up for a rally.
Okay, so market set up for a rally. Where do you want to be?
I want to be in more cyclical, riskier areas in the market. So in the spring, we were favoring REITs and utilities, some of the more defensive areas of the market. Now I think you want to begin to move into the more cyclical areas of the market. I would put banks in that category. I would put semiconductors and tech more broadly in that category, consumer discretionary, those economically sensitive areas that have been beaten up. I think it's now time to begin to nibble at some of those names.
And healthcare? Have you said that healthcare has just been overcrowded, right?
Healthcare is very crowded. I think it's going to take some while to work that out. It's a great sector in the long term, lots of good secular things at work in the healthcare sector, but I would not be buying the dip just yet.
Okay. Earlier this morning, Bloomberg Go had Mark Lazary on speaking about the markets and the Fed. And Eddie, I want you to hear what he said about that.
Energy today is a phenomenal opportunity. It really is, because you can buy the senior secured debt of a vast majority of this paper is trading at 40, 50, 60 cents. You're getting paid at current, right? So if it was a 7-8% coupon, you're now getting 16%. So you're getting the optionality to wait. You're getting paid to wait for the next 2 years. But don't you have to...
Okay, so that's one angle to the markets he's saying is energy. What do you say?
Energy is an area that we've been underweight and more defensively positioned in. I felt like there were a lot of people looking for bargains in that sector at the beginning of the year. We didn't participate in that, but I think we're getting closer to the point where that is the right call. Getting the timing right is difficult because I don't expect a snapback in oil prices anytime in the near future.
And what are you waiting for?
I think for sentiment to really wash out, for there to be a real sense of capitulation, for people to throw up their hands. You still have a lot of people talking about the long-term oil price is $65 to $70. If people start to question that and say, well, maybe it's permanently below 50, that would be an indication to me.
That's a contrarian indication.
As a contrarian indicator, yes.
Okay. Earnings season is starting this week.
Yes.
So what are you expecting from earnings?
I think this is going to be a poor earnings season in terms of reported results. We'll probably see negative earnings growth year over year, largely driven by energy, where I think estimates are that they'll be down 65% year over year. But again, that's understood at this point. And so I think we're troughing this quarter. We'll probably be flat in the fourth quarter when we get those results in January. And then I think we set up very well for a strong 2016 from a corporate earnings perspective.